I thank Ms. Tan Shu Shan and Professor Tan for their comments on the FHC bill. Ms. Tan referred to smart regulation, or regulation that is no more burdensome than necessary to achieve our regulatory objectives. That is, as she mentioned, indeed the MAS's approach, and we will continue to take that approach. In other words, maintain high standards of regulation whilst ensuring that the application of regulation, be it on liquidity requirements or leverage caps, as she mentioned, is risk appropriate to the risks posed by the institution or the group, and proportionate to those risks. The FHC framework was therefore designed such that FHCs in Singapore are not automatically subject to regulation. MAS will designate an FHC for regulation only where doing so can enhance the effectiveness of prudential oversight of the financial group. Let me explain further. Under international supervisory standards, the supervisor in the jurisdiction where the ultimate parent FHC is based is expected to carry out consolidated supervision of the financial group. MAS will therefore designate for regulation of the FHC a financial group that is headquartered in Singapore. An example will be DBS Holdings. By this same principle, the home supervisor of a parent group to which a foreign-owned FHC belongs is also expected to carry out consolidated supervision of its financial group, including the group's entities operating in Singapore. However, MAS may also designate a foreign-owned FHC in Singapore for regulation in two situations. First situation is where the foreign bank or insurance company in Singapore is significant to our financial system. The second situation is where the bank or insurance subsidiary is significant to a subgroup of related companies, in other words, to an intermediate FHC group based in Singapore. MAS will designate such a foreign-owned FHC for regulation if doing so can enhance prudential oversight of the financial group and provide assurance to Singapore depositors or policyholders that potential intra-group risks posed to the Singapore bank or insurance company are adequately supervised. With regard to Professor Tan's question on how many FHCs we envisage being subject to regulation under the bill, at this point in time, there are 5 FHCs that meet the criteria to be designated for regulation as FHCs under the bill. All 5 are FHCs of banking and insurance groups that are headquartered here. Ms. Tan also commented on the need for consistency with international regulatory norms. That is key to MAS's approach. The FHC bill is consistent with international regulatory developments and standards for group supervision. Let me now address the specific areas raised by Professor Tan and Ms. Tan. Professor Tan spoke about the possibility of overlapping regulation or regulatory gaps arising from differences in regulatory regimes in different jurisdictions. He gave the illustration of an overseas financial holding company in country A, subject to country A's regulation, which acquires a regulated entity in Singapore, subject to MAS regulation. Let me explain how the regulatory regimes across jurisdictions interact. MAS will impose regulatory standards on the solo regulated entity in Singapore, which may be a bank or insurance company licensed under the Banking Act or Insurance Act. The foreign regulatory authority in country A, the home jurisdiction, will exercise regulatory oversight over the FHC, including the regulated entity in Singapore, at the group consolidation level. So it's a division of responsibilities between regulation of the solo entity and the regulation of the group. There could therefore be overlapping regulation with regard to the regulated entity in Singapore, due to MAS and the foreign regulatory authority addressing risks at different levels, namely the solo and the group levels. However, in respect of the regulated entity in Singapore, MAS as host regulator would not defer to the foreign regulator with regard to the solo regulation of the bank or insurance company. The company is subject to MAS's minimum regulatory standards. MAS's FHC regulations will nevertheless not apply to the FHC itself in this instance, as it is not incorporated in Singapore. Further, amongst banking and insurance regulators, because I think Professor Tan does rightly point to the potential for overlapping regulation or regulatory gaps, but there are well-established principles for cross-border collaboration and cooperation. Not perfect, but they are working principles, including information sharing, to facilitate effective group supervision of cross-border financial groups. In fact, this has been a very important emphasis post-financial crisis, getting more effective international collaboration for the supervision of cross-border and cross-sectoral financial groups. So MAS will collaborate actively with its regulatory counterparts to ensure adequate supervision of the bank or insurance subsidiaries in Singapore. I should add that MAS will also apply similar regulatory standards to solo entities in Singapore, regardless of whether the bank or insurance company is held by a holding company based in Singapore or overseas. Next, Professor Tan had also asked about how the proposed FHC bill would deal with various organizational forms of financial groups. And related to this, Ms. Tan had also commented on the need for a level playing field. The FHC bill sets out MAS's regulatory approach and powers for financial groups that are organized under a non-operating FHC. As Professor Tan mentioned, financial groups or downstream financial subsidiaries may also be held under a Singapore-related operating entity, such as a bank or insurance company. Regardless of organizational forms, MAS as the financial regulator seeks to ensure a consistent regulatory approach. For example, a banking group organized under a non-operating FHC will be subject to rules at the group level that are consistent with rules that apply to a bank-held financial group regulated under the Banking Act. That's the basic principle. To achieve this, the regulatory requirements for a bank under the Banking Act are mirrored in the FHC bill, where appropriate. Finally, Professor Tan asked about the regulatory approach for FHCs of mixed groups. In other words, groups which have operating businesses in more than one regulated sector, in particular in both banking and insurance. That's a good question. We will use a predominance test. In other words, whether at the group level, the FHC is principally engaged in banking or insurance business. An FHC group that is assessed to be predominantly banking, for example, will be required to adhere to the potential rules governing the banking sector at the group level, such as large exposure limits. In practice, the financial groups in Singapore are either predominantly banking or insurance. However, this could evolve over time, and there could be hybrid groups where there may be more of a balance between banking and insurance. It's entirely possible. But in all instances, MAS will assess the group in totality to obtain a holistic picture of its risks and determine the appropriate regulatory or supervisory treatment. So it's not a binary treatment where it's either banking regulation or insurance regulation. There will be hybrids, and we will have to look at the entity, the group in totality. In summary, MAS has proposed a single piece of legislation in the form of this FHC bill to strengthen MAS's prudential oversight of financial groups in Singapore. A single bill to regulate all FHC group structures offers clarity and consistency as far as is appropriate in our regulatory approach to bank groups, insurance groups, and mixed financial groups held under a FHC. Going forward, MAS will formulate the detailed regulations to bring into operation the FHC bill. And we will, as Ms. Tan suggested, continue to first consult widely, and second, to ensure that we apply a risk-appropriate approach. Over the course of the past year, as I mentioned, we've consulted the industry both on the broad policy proposals as well as the draft bill. And we will, when it comes down to the detailed regulations, engage in more specific discussions with the lawyers, with the individual institutions, and with all other stakeholders.